Well, thanks for being here, folks. I'm Roger Royse. I'm the founder of the Royse Law Firm. We're a corporate business and tax law firm with offices in Northern and Southern California. And today we're here for one of our series of presentations here. Wow, how about that? Yeah. It does work. One of a series of presentations here, and today we're going to talk about crowdfinancing, in particular crowdfinancing entertainment projects. And we've got a great panel here to talk about this. There's that noise.
It's okay, Barry. It's a delay. It's a 1 minute delay on it. That's you're hearing
just
what.
Turn the volume down over there.
No, it's yeah. You can turn the volume down on the phone if you want. Sure.
So before we get started, and before I introduce the panel, I wonder if I'd like to get a sense of who's in the room. We build this as crowdfinancing entertainment. How many film or entertainment industry folks do we have here tonight? Okay, how many non-film startup entrepreneurs? Okay, and none of the above. All right, so a few service providers it looks like as well. Okay, well that's great. I think there's going to be something here for everybody. We're going to go for about an hour. I'm going to save some time for Q&A, so make sure you save your questions. And before we get started, I think I am going to ask our panelists to tell you a little bit about who they are, why they're here, what it is that they do, what they bring to this. We have with us Kinsey Cronin. She's from StartEngine. It's one of the platforms. We were chatting earlier. They're doing quite a bit of these crowdfinancing deals, and they've really kind of set the template, both crowdfinancing as well as something we're going to talk about tonight, the Reg A deals that you might have been reading about, or Reg A Plus as we call it in the papers. Gene Massey is with MediaShares. Gene and I have been on crowdfunding panels ever since the Jobs Act was first enacted about 4 years ago now, I think. So he's a very frequent speaker and panelist, not only on crowdfinancing, but some other very innovative financing techniques that companies use. And then Dorothy Vinsky, who is a lawyer. She's a startup company lawyer. She's also a professor at Loyola Law School. So that's our panel. And before we get started, why don't we start with you, Kinsey? Maybe you could say a few words about who you are and what StartEngine is all about.
Sure. Hi, it's actually StartEngine. That's a really common mistake. StartEngine is an equity crowdfunding platform where we specialize in online public offerings. So that's Title III and Title IV of the Jobs Act, which are also known as Regulation Crowdfunding and Regulation A+, which means that we create a space where companies can meet investors, and that's non-accredited as well as accredited investors.
I'm Gene Massey with MediaShares, and in '98 I went to an attorney friend of mine and I said, there's going to be all this financing on the internet, and I've got this wonderful way to finance movies by selling stock on the internet. And he said, don't even think about it, you're wasting your time. But I pursued, and over the years the Jobs Act was passed, and now it's possible for an entrepreneur to go on the internet and actually get funding. There are people that are going on StartEngine and posting an offering under some very strict rules, and even getting money from non-accredited investors, getting money from anyone. And so that's the purpose of this meeting tonight, is many entrepreneurs want to know, how do I get some money for my deal on the internet? And so that's what we're here to talk to you about tonight. MediaShares is basically, for many years, was a marketing company, and we still do marketing. We've done some consulting with entrepreneurs that need guidance as to which lawyers, which portals, which marketing companies should they work with. And we're not a broker, so we don't take a commission on anything. A lot of people say, can I give you a percentage of the deal after we get the money? And only a broker can do that. So, but we do still work as consultants, and we're very excited about things that are happening now with companies being able to get the funding on the internet that they need.
Hi everyone, my name is Dorothy Vinsky. I'm a corporate securities attorney, and I started my practice in Northern California and primarily focused on securities offerings for private and public companies. And I continue to do that work here in Los Angeles. I have my own practice and I teach part-time at Loyola Law School. One of the things that I find interesting about the Jobs Act and this equity crowdfunding that the SEC kind of formalized and finalized this May is that it radically changes the ways that companies can raise money. So for years, companies could raise money primarily from accredited investors, and this really limited them in terms of potential sources for financing. So this is really revolutionary in my opinion, and I've actually received some requests from potential clients to help them potentially with these kinds of offerings, and so I'm here to share with you what I've learned about it and how to do it. Thanks.
Okay. If you're tweeting tonight, you can tweet to hashtag Royse University. You can also tweet to me on Twitter at rroyce00 with an S. You guys got a hashtag or a Twitter handle?
Yes, you can tweet at StartEngine. You guys have one?
Crowdfunding IPO.
All right. Everybody in the back here okay?
Yeah.
Okay, good.
Okay.
All right. Well, let's start by defining a few terms, just so we're all on the same page here. Can you tell me, whoever wants to take this, what's the difference between crowdfunding and crowdfinancing? Because I hear those terms used sort of interchangeably, and I think people sometimes confuse them. Go ahead, Gene.
In 2006, prior to 2006, I was calling it fan financing because there was actually the Chicago Cubs financed part of their stadium. Justin Wilson financed one of his Formula One season. The late Justin Wilson financed his Formula One team for a season by his fans. So there was a big thing about people being able to get the money on the internet from their groups. And then along came Kickstarter and Indiegogo, and they were donations. And I thought, I should have thought of that, because I was trying to do it as an IPO, and an IPO is very expensive. I was trying to do it as you sell stock and you give some dividends, and they were doing it donations. So they started the phrase, they and some other people started the phrase crowdfunding, and it became known as a donation medium. And now that StartEngine and portals and attorneys and new laws with the SEC, we're calling it crowdfinancing, because you can actually go out and get equity. So a person doesn't donate, they actually invest, and maybe you still get a ticket or a book or something that you wanted to get with a donation, but you can now get it with an investment. You know, the guys with Oculus, they were on a donation portal, and I forgot, what did they get, $2 million or something?
We got over $2 million.
They got over $2 million, and that's what got them going. And then when they sold to Facebook for $2 billion, none of those people got anything. They didn't get anything. They got whatever reward they were offered initially, the gizmo or whatever, but they didn't participate in that $2 billion windfall. And so now you can. And that's what's so exciting about StartEngine and portals like that, is that you can actually participate. You can not just donate, you can invest. Maybe you get a product or something with it, but the big thing is that you share in the profits.
Sounds too good to be true. So Dorothy, is there any downside to this? And by the way, I have to warn you, lawyers are pessimists. I heard the other day.
There you go, Dorothy. That's our job.
As a lawyer, I'm such a pessimist that if I were an optimist, I'd probably drown in a half-full pool. So let's give you an idea.
Well, hopefully it helps protect the clients. That's the end goal. But some of the disadvantages to raising money with regulation crowdfunding is really the cost of compliance. So there are some corporate securities attorneys who believe that the cost of raising up to $1 million under these new equity crowdfunding rules is a really expensive way to raise money. And some of the reasons are that there's some cost preparing the Form C, which a company has to file with the SEC and provide to the platform 21 days before it offers a security or sells a security. And the SEC estimates there's, the range to prepare this Form C is from $2,500 for a small offering to $50,000 for an offering up to $1 million. Why? Because there's some disclosures that are required about the business, ownership, capitalization, financial statements. You have to be GAAP compliant for 2 years. I'm going now into the details, but
You're
there's some
getting ahead of
disclosure.
me a little bit. Let's just again take a step back on our terms, because in my mind, so sort of crowdfunding breaks down into the reward space, like Kickstarter. You don't get
Okay.
equity, so Oculus sells for $2 billion, and you get the satisfaction of knowing that you owned. There's 506B deals where you don't go out and publicly, if I'm getting the numbers right, you don't go out and publicly solicit, right? And those are, I think AngelList is probably a platform that lists that way. So it's accredited only, but you're not advertising, and you don't have to verify. Then there's 506C. Can you tell us how that works?
Sure. So 506C is a variation of 506B, which is the traditional way to raise money with accredited investors. And the primary difference is that with Regulation 506C, general advertising is permitted to accredited investors. And so that.
Tell them what an accredited investor is.
Sure. So accredited investor is either an individual or an entity that meets the SEC's criteria for being able to purchase securities of a private company. So if you're an individual, you have to make at least $200,000 a year, or with your spouse $300,000 a year, or have net worth of $1 million or more, excluding your primary residence. And so only people who meet this wealth test can invest in Rule 506C.
It's about 4% of the population can fit there.
Got to be a millionaire essentially to invest in a general solicitation under 506C. And we got a question. You want to just take questions as we come, or?
Well, we can. We'll go ahead.
Well, it's just in general, maybe like on some human level, like take this location. Let's say I want to open 10 or maybe $18 million. Can you tell me the process? We've never done any kind of solicitation from start to finish, and then on a recurring basis, we'd expect to, like, let's say I have a business and I can make 10 locations like that. Just a real simple corporate finance activity. Like maybe like the parties involved can just say like what we need to do, what it costs, and how we can do it first. That would be very interesting.
Sure, yeah.
So the question is.
Oh, the question is, what exactly does it take to raise money this way?
What are the steps?
Yeah, so the
And
steps
for
are
like a couple $1 million bucks. What does it cost to just have the state?
for a couple million. Okay, so if it's going to be more than $1 million, then you're talking about Regulation A+. So that cost is actually.
He's talking about 506C too.
Oh, you're talking about a 506C. Well, I can't help you with that one. StartEngine is.
Let's say you're going to raise $1 million and you're going to use Kinsey's platform to do it.
Okay, so we'll start with 1 million. That's Reg CF. So all you have to do is get a financial review for your company, and
CPA, right?
yes,
CPA.
from an independent CPA, and then you also need to have a lawyer prepare a Form C document, which you need to file with the SEC. And then you need to spend a lot of time thinking about your marketing strategy. So if you've never solicited at all, you probably don't have a community. You need to be able to reach out to a community in order to actually take in funding if you're going to go for non-accredited and accredited investors. So when you're reaching out to everybody, you have to be able to reach a lot of people, as opposed to doing a 506C, which would be when you're going only out to accredited investors, and you'd have a different type of strategy.
So if we go that route, how much can each individual invest?
So this one is actually even more complicated than determining whether or not you're an accredited investor. Under each regulation, it's a little bit different. Under regulation crowdfunding, so that's up to $1 million, each investor can invest at least $2,000, but they are limited $2,000 over the course of the year in all regulation crowdfunding raises, and they can raise at least $2,000, but they are limited after that by their own net worth or income, similar to what determines whether or not you're an accredited investor.
By the way, what are the verification standards for small businesses? That seems kind of impossible. Realistically, it's even when you reach out to each other in your house.
Well, you do have to go through a registered funding portal. StartEngine is a registered funding portal, so the businesses that launch with us don't make that verification. We handle that. So essentially, if your net worth or your if your net worth is under 100,000, then you can invest up to 5% of it. If it's over 100,000, then you can invest up to 10% of it.
In your portal, would actually verify those things?
Our portal, it is self-reporting. Our portal doesn't get into the invasive process of checking and getting proof.
The person is self-certifying their income.
But our platform does follow the law in terms of making sure that the right questions are asked and that the answers are verified and match up with the amount that's being invested.
And from a legal standpoint, is that sufficient?
Yes.
Like self-reporting, okay.
Well,
Can I address why that is that rule?
Right ahead.
You know, the SEC wants, here's what the SEC doesn't want to happen. Granny spends her last money on your little entrepreneur idea and is broke and can't pay her rent anymore because she invested in your little deal. So they limit the amount of money that certain people can invest according to their net worth. They figure if you're a millionaire, somehow first of all, you've got enough money so that if you invest in an entrepreneur, you're not going to be destitute and homeless because of it. Second of all, if you got $1 million, you're probably fairly intelligent if you've kept it for any period of time. So they figure they have to set a standard somewhere. So they say $1 million or $200,000 a year to protect the investor. The SEC's job is to protect the investor from making terrible investments. You can invest in Enron, that's okay. You can go to Las Vegas, put all of your Social Security check on Red 29, but you can't invest. They want to protect you from investing in certain things. I don't think it's fair. As a matter of fact, there's a gentleman right now who's filed a lawsuit against the SEC saying it's unconstitutional to be able to limit me according to my poverty. I'm poor, therefore I'm too stupid to know what to invest. So he's got a lawsuit filed. Everybody says it's not going to work, but he's an attorney that's very serious about it. His name is Chase Morello, and I've had lunch with him. He's a smart young man, just out of law school, and he agrees with a lot of people that it's unconstitutional. That said, all of these rules are built around protecting the investor, and you have to have a lawyer. If I want to raise some money, I have to have somebody like Dorothy prepare all of these sophisticated documents that tell the potential investor of the risks of my investment. The risks, that's really the purpose. The lawyers prepare the documents for entrepreneurs so that they can be, and it actually is good for the entrepreneur, because if you go out and you take somebody's money this is their money they're giving you, you know, and you take their money and you fail. You want to be able to show, I told you of the risks. Because if you don't, if he says, you never told me I might lose my money. So you want to avoid that by having very good counsel to help you prepare all of your documents according to the rules. If you don't do it according to the rules, there's actually prison time for if you defraud people and cheat and stuff. So you need a very good attorney to prepare you for all of these types of offerings. And it's, you know, it's part of the game.
Well, let me just follow.
That's just a quick follow-up to something that was asked. If it's a new entity, and you're doing the company, I guess it's an audit. Is it a zero audit if it's a new entity? Is that acceptable, or how does that work?
So you do a financial review under Reg CF, a financial audit under Reg A+, and if it's a new entity, it would just be for the life of the entity. So some of our companies do just have lists of zeros because they don't have anything yet.
Got it. Thanks.
Okay, one more.
Sorry, what about valuation? Like, do we need to get independent valuation?
Yes, but you can structure the valuation. So the CEO, the entrepreneur behind each project or company, gets to set the valuation. They don't have to agree to a negotiated valuation the way that they normally would when raising from VCs.
But you mean professional valuation is what you're asking about.
I guess when I'm raising money, I have to show the valuation of the company.
Yes,
Right? So
you do have to show it, and yes, I would recommend that because you do want to make sure that that it's a reasonable offering, because the crowd will reflect that. If you set your valuation too high and the offering isn't a good deal, then people are less likely to invest.
We got so many questions. Why don't we go ahead? I'm more interested in what you think than what I think. Oop, what your hand was up.
Because I heard something neat from Republic, which was here a couple weeks ago, policy, so they have a crowd equity safe. So if you don't know the valuation, put in the market cap, which could be reasonable, could be high, I don't know. But it allows people to say, we don't know what the price is yet, but we're in. So how do you feel about the setting a share price and valuation, having a safe or a note when it's through a crowd platform?
Okay, so what you're talking about, the safe or convertible debt, these are securities. They're actually, so the safe is like convertible equity. It's like a warrant. It's an investment that will convert when you do your next institutional round. I don't know how you would list something like that on a crowdfunded site, because I just assume that you're not going to do an institutional round after you do a crowdfinancing. Kinsey, would you let a company sell a safe or a convertible debt on your platform?
That's something that we've been discussing, and I can't really say firmly a yes or no on that. There's an aspect to that which is great. There's also, because it helps protect the issuing company, there's an aspect that could potentially be very unfair to the investors if then the company got a great round of funding and was recognized and had this high valuation, that it could prevent these small-time investors from participating in that and actually getting the return, which is a reason to invest in a company that is high risk in its early stages. So while there's a level of safety that is bestowed upon the company, it's not exactly in the spirit of what we're trying to do here, which is democratize capital for everybody. We want to create a great opportunity for the investors too. So, but that is to say there could be certain modifications on that to make sure that it's fair for everybody.
And the nice thing about StartEngine and good attorneys like this is they'll help you. You may not be able to get a very expensive valuation from a firm that's based on your projections, which could be anything, but they will help you. When you post on a portal like StartEngine, they'll say, you know what, you really don't have a $100 million valuation, you know, and they'll help you. And so you get good help on this sort of thing, and you may be able to do that without having to spend an expensive valuation.
Yeah, if you're interested in that topic, our StartEngine blog, I actually don't remember if it already posted or if it's about to post. We have a sort of article on that's on our blog if you want to check it out.
I'll give you my 2 cents. I just think it's a great deal for the company, but it wouldn't be a great deal for an investor. For this type of company, a company that's doing a crowdfunding, I'd want to do a priced round if I were an investor.
Yeah, venture capitalists don't like safe notes.
Yeah.
They hate them.
Nick? Come on.
And also just to add,
I guess what the original question was trying to generate, without getting all the regulations down, it sounds like what you're talking about is fairly expensive professional fees.
Oh, that's my question. I was about to ask that. So
yeah,
let me follow up.
So like when you, I mean, like if you're talking about even a review by a sort of an independent accountant, and I assume some primitive version of a private offering memorandum.
Well, let's add it up. Let's add it all up. So it's not either a broker or a platform, right?
Mm-hmm.
Something that's a lot like a business plan that gets filed with the SEC, or a PPM, or a disclosure document.
Disclosure documents,
An
yeah.
accountant
Got a
review.
description of what you're going to do, right?
Isn't that kind of a lot for $2,000?
Well, that's for the investor, but for the issuer?
No, I'm talking about the issuer.
issuer.
You're going to raise $1 million. I mean, in my private placements, we don't do any of that stuff for $1 million, but you have to do that for these. So, aren't the transaction costs kind of high for these
They can be. They can be. We've seen the accountant's role start at $1,000.
Wow.
Yeah,
That's
and we've
pretty
also
cheap.
seen the legal role start at $1,000 too. Now that's obviously going to be for the simplest offering. Marketing is going to be dependent on the current community and the skill set of the team behind the offering. So if you don't know anything about marketing and you don't have a community, you're going to end up spending a lot of money working with people to make sure that your message gets out there. If you're extremely skilled in that already, if you're great at marketing, and if you have a community that's already sort of drawn to what you're doing, it's going to be easier. It's definitely going to vary for different companies. Dorothy, did you have something you want to say?
Yeah, on the cost issue, I just wanted to add that it should be less for a first-time issuer because the requirements for financial statements are less. They don't have to be audited, so it should be more reasonable.
We've got an exemption for first-timers.
Yeah, you know, I think I misspoke earlier when I told you that it wasn't an audit. What I should have clarified is that that's when you're a first-timer for this regulation.
This gentleman
I
here.
just have a question in regards to legal costs. Obviously, any business, any startups, that's usually the biggest bandwidth to get things up and running. Are attorneys getting involved in this particular new SEC law by helping to lower costs with typical startups to get these types of filings accomplished or implemented? Because it is pretty expensive, especially if you're dealing with a major law firm or even a small law firm. Costs really operate these types of documents.
Okay, so sure. So I'll address that issue. On the, I guess, more conventional types of raises, you know, the Series Seed or venture capital raise, the range is, I'd say, $15,000 to $25,000. If it's more complicated, it can be higher. Maybe possible to do it for less, but I think that's the range here in Los Angeles.
What's the cheapest of all the offerings? What would be the least expensive type of offering that somebody could use to raise funding? The 506C probably.
A 506, yeah, 506C.
See, the more you address
to
non-accredited investors, the more expensive the legal fees because you have more disclosure and more risk factors and more to deal with.
But you know, there's this thing called the Crowdfunding Act bill that's floating around Congress that is going to solve a lot of these problems. And I'm glad to see that people are out there, you know, putting platforms up because there are proposals in Congress that keep addressing these things. It's legal innovation in a way because you try something, you see what works. If it's too expensive, we go back, adjust the law. So hopefully we're going to get some more favorable law on this at some point. You had a question?
Yeah, can you talk a little bit about what actually what is in these disclosures? What do you need to disclose to people, both from a legal standpoint and to be successful marketing your investment? So, I mean, from a legal standpoint, could you just simply say, hey, I have this idea, and you could lose all your money. Here's my background. But, so from a legal standpoint. And then on the marketing side, what do you really need to do and disclose to people to be successful and have a successful raise? Because it's sounding a lot like Kickstarter in the sense that you have to come with a community to get other people to invest. You need that sort of like
good question.
Pre-marketing and network, and then come to your portal and be successful.
So let me repeat the question. So it's two things. Dorothy, one's for you. You're going to have to define materiality for us here. Like, what do you legally have to disclose? Everything you don't want them to know, is my opinion. And then secondly, as a marketing matter, how do you properly package these things so that you don't fall flat on your face with your equity crowdfunding? Dorothy, why don't you go first, and then you'll take the marketing one.
Yeah, so starting off with the legal requirements, they're essentially twofold. There are the guideline requirements. We call them the line item requirements. So, for example, description of your management, directors and officers, owners of more than 20%, and I'm talking now about regulation crowdfunding, owners of more than 20% of your company, any related party transactions, a description of your business, a description of the securities, your capitalization structure, your offering, also financial information, also, use of proceeds, also prior raises that you've had, right? Any any changes in your capitalization structure, and also risk factors. What can go wrong. And then, in addition to these legal requirements, you're also required to disclose any material information that
like you're wanted in 6 states.
You're not going to be able to do it if you're wanted in 6 states.
Yeah, so
4 states is fine.
Yeah. So an example of that would be, if your directors or officers have a financial interest or an ownership interest in maybe one of your key customers, that kind of disclosure, the SEC considers it materiality. Just a second, I'm almost done. And then, and the definition of materiality is information that, under the circumstances, is, if it was omitted, would be misleading to an investor.
So Dorothy, what happens if I make a mistake and I forgot to mention that I'm a convicted felon or something?
Ignoracius legis non est excusia.
Yeah, then...
Ignorance of the law does not excuse.
Well, disclosure may be required. It would depend. It's a fact and circumstance analysis. Depends on what
material. Suppose I'm being sued, but gee, I don't really want to tell that to the investor because then he won't invest. So I just admit that fact. What happens when he finds out?
Okay, then in that circumstance, the recommendation generally would be to disclose it.
But I mean, what's the legal
litigation.
consequence?
He wants to know if somebody's done that and then they find out later he loses the money, and what can the guy do?
So potentially rescission, of the purchase of the securities, potentially a fraud claim also.
Personal liability?
Yes, personal liability.
You're guaranteeing the investment. So it's tricky stuff.
So what you're saying is if I'm an issuer and I don't disclose certain little funny things that I'm doing, right? And they find out later after I've lost their money, then what can happen to me?
That's what I was asking Dorothy.
Okay, so you can get in serious trouble. So you really you're getting into an area that is very, very sensitive to any mistakes, any misrepresentations, any lack of disclosure, not telling people what the truth is. And so it's a serious business, this securities business.
So I'll just tell you that I don't know that this is more lore than law, but with these accredited only deals, you kind of worry a little less about that because they're big boys. They've done lots of these investments. They know what questions to ask. They can protect themselves. And mostly they're not going to get really, really pissed off if the company fails, because 9 out of 10 do. So I'm not that worried about them suing the company. But with unsophisticated, non-accredited investors, I want to be way more careful not to give them a hook if they start looking for reasons, to get their money back.
But we haven't seen it yet, but
No,
that's
right,
sort
right.
of an
Well,
expectation.
I'm a
So
pessimist.
it's speculation,
I told
and you guys are lawyers, yeah?
Can I address something?
Yeah.
The nice thing about a portal like StartEngine is you can take tiny investments. You can take $100 or $500. And the people say, oh my goodness, what a wonderful idea. I hope these 2 boys succeed with their wonderful idea. And if they fail, I only lost $500. So the word crowdfinancing really means spreading the risk of your investment over a large number of investors. How many? What's the most you've ever had on a?
We've had
6,000?
about 6,300.
So you have 6,300 invest, a few $1,000s a piece in this one case. But in many cases, people invest $100, $500. And you go out to the crowd. Now the issue, the second part of the gentleman's question was marketing.
Yes.
So you want to get a lot of people to invest a little. What are you going to do to get to reach a lot of people? That's the issue. And how much, there's something called CPA, cost per acquisition. For me to get $500 from somebody, how much does it cost me to reach enough people to get one of them to put up $500. So the marketing costs can be enormous for one of these offerings if you don't already have a lot of users, an affinity group, customers. If you don't have a large base of people that you can reach out to with your offering, then you've got to advertise and market and go out and reach strangers. You've got to go out to bloggers and people that are in that particular field. Bloggers and tweeters and all kinds of people that are specialized in that tire business or something. And all the bloggers in the tire business, you go out to them and you get them to blog about your wonderful new tire that never wears out. You get 900,000 miles with your new tire or whatever, and you get them to blog about it, and everybody goes to your site based on their blogs. So you have to have a marketing campaign, and Kinsey can address that, because all of the offerings that go on her portal, the first thing they ask you is, how do you plan to market this?
Can we pause for a minute on the legal issue here? Because I want to make sure we understand that what he's talking about is advertising the business, not the sale of the security, right? Dorothy?
No, I'm talking about the sale of security.
Dorothy, any problems with that?
Well, I wanted to add.
Now, see, I might be already in trouble. Cut the
Just
camera
some
off. I'm in big
guidance
trouble already.
That is one of the great things about equity crowdfunding, is that you can market it to the public, but the content of the marketing is limited in nature. And the SEC has issued very specific rules, right, as of May for the content, and in their release they said that they based this on Rule 134, which is what we used for IPOs.
Yeah, conditional market.
Right, which we called a tombstone ad. And sure, so where's the mic? So the content of the notice is it's limited, and you can say your company name, your company contact information, a brief description about your business.
This is in she's talking about Regulation CF,
right,
which is highly restricted on the platform. You can't.
Yeah, so you can't post a glowing kind of article about your company. The notice that you can give to the public about your CF,
we got the best thing ever. We're going to make $1 million. No, you can't do that.
No, it's really.
You can direct them to.
Right, so you direct them. Provide a link to the platform where they can read your business plan.
Run a campaign, but not really offer your campaign your company offering. You just direct them and say, we're pitching this product and it's for sale here.
So
The
way that we look at it is there's two types of information. There's the hard information, so that's the information, the specifics about your offering. So information about the fact that it's an investment, the valuation of the company, the number of shares available, when the offering opens and when it closes. But then there's other information about your company that's soft information. It says that we're running a campaign on StartEngine, and we are a company that does this and that, and we're trying to change the world. And you can actually say that as long as you don't include that material information.
Terms.
That's the interpretation of the law that we operate under, and that other platforms like us are currently operating under, and that the terms, as long as if you do include the terms, then it can only be a tombstone. So it can only include terms, or it can't include terms at all. And then, of course, you would want all of those different types of marketing pieces or advertisements to all link back to the page where all the information is available in one place. And that's really what the SEC wants, is for a person to be guaranteed to be in the location where all the information is before making an investment.
So everyone can see the same information.
Mm-hmm. It has to be online.
Has to be online. Stuff like if you had a investor who had a question for you, question would have to be asked in public, and then you respond to it in public. So it's all forum style. So an investor couldn't send you an email, and then you couldn't have a chat and meet up with them. It would have to be the type of thing where that person's question was addressed in front of anybody else who wanted to see who wanted to see what was going on. So maybe.
Can you make me a deal on your stock? Give me a
no, you
discount.
certainly can't make any deals. But more importantly, if I want to invest in something, and I didn't think about an important aspect of this, but somebody else did, and they asked that question and it got answered, I deserve that same answer.
Over here in the corner, you've had your hand up for a while.
I'm glad you're shifting gears. I'm in like an idea stage of creating a company, and I have an idea, I have a product, I have a good network. I just don't know where where I should start to help that portion. And wanting to create a business plan for that.
So the question is, how would you go about doing a crowdfunding campaign when you're just idea stage? You haven't done any business yet, you don't have a product yet, no R&D.
I have, there's a catering company, I'm just converting the catering company into a grocery store. So I have a complete business, but just probably not an attraction.
Yeah, what does it take to get started with one of these? Is there a minimum viable company that you need to get listed on exchange? Go ahead, Gene.
Well, you need to put in every case, you need to put yourself in the mind of the person that you want to get an investment from. And so you say, if you have your Uncle Charlie who loves you dearly and who wants to see you succeed, you go to your Uncle Charlie and you tell him about your plan. And if you can convince him, then you know. And if you have 3 or 4 Uncle Charlies and Aunt Susie and people and friends and family, it's called, because those are the people that know you, they care about you, they want to see you succeed, and they'll listen to your idea. And if none of them invest, then you know maybe you should rethink it. Now, if all of them say, "This is terrific, let me speak to Cousin Bill, who's got a lot of money." You see what I'm saying? They'll refer you to someone, but that's your first step when you're in the idea stage. To post your idea on a website, you're not likely to get anything, in my opinion.
So how would I raise this for my friends and family if I have a PowerPoint?
Well, you go have a chat with them, and you tell them what you know. You draw it on a napkin if you have to, and you explain it to them. Well, you don't need a business plan yet. You need to be able to give them a very good explanation in person at an idea stage of what you plan to do. And generally, you will only get money from people that know you and care about you, because you don't have any proof yet how you're going to get their money back. That's what a business plan is for, to give someone a reasonable idea of how you expect to give them back their money in a multiple with a profit. See, that's what the business plan is for.
How about if you didn't want to do that, or you just wanted to raise funding?
You're not likely to do it.
Really?
You're not likely to do it, in my opinion. I mean, maybe I'm wrong, but you know, if you're a scientist and you've got tremendous credibility at MIT and everybody believes in you, and you say, "Listen, I just discovered anti-gravity," or whatever, and you might get some people to get excited, but other than that, I don't think you'll get much money if you don't have a really good, solid business plan that lays out all the facts and figures, and then you have sound legal advice from top people like these, and you know, then you've got a chance at it. Money is hard to get on the internet. You're asking people to give you their money, you know. It's tough.
Green shirt in the back.
So we talked a lot about XCX, and you mentioned to what you that XCP investors. That was actually the same email about the capital raise Reg A on the StartEngine platform, right? So can we maybe shift gears a little bit and understand kind of the type of read that you guys do, the type of flow that you guys do? And then also, I think a lot of people don't know that you guys have kind of like a scholarship fund type marketing. If that's still going on, can you maybe talk about that? That would be helpful.
Okay, that's a lot of questions there, but let's start with, you want to talk about Reg A. So let's talk a little bit about that, or what I call Reg A Plus. I guess you called it something else. But Dorothy, can you explain initially what the legal requirements are for a Reg A offering and what it is?
Okay, so a Reg A offering is a mini IPO, and the company prepares a disclosure document that it would, for an IPO, but and And it can use this document to test the waters, to see if there's interest among investors. That's one of the key advantages to doing an offering this way. It is a public, it is a public offering. One of the downsides is that there may not be a market for the shares, but setting that aside, the SEC did issue new regulations in 2013 to make some modifications and increase the amount that can be raised under Reg A to $50 million.
So 50 million is
50,
the number, right?
yeah.
That's how much you can raise under this new Reg A.
Per year.
Mm-hmm.
Per year.
And it's public, so you go out to the market, raise it publicly from accredited and non-accredited, so from anybody.
Right.
And you just have to do a fairly extensive filing with the SEC.
Right. So if we were to compare it to regulation crowdfunding, Rule 506B or Rule 506C offering, it has the highest disclosure
The highest
requirements.
disclosure requirements.
Yeah.
What's the difference between that and an IPO if I'm going to go to all the trouble of doing this disclosure document?
Yeah. Well, there's some, some scaled back disclosure.
So it's
So
less expensive. Okay. Kinsey, you've done Reg A deals on your platform.
Mm-hmm.
Talk a little bit about your experience.
Sure.
How much you've raised.
So at StartEngine, there is a lot of terminology. It's a new industry. We actually refer to both types of raises as OPOs, or online public offerings, and we call, when it's under Reg CF and it is up to 1 million, we call that a small online public offering, versus a large online public offering, which is going to be most likely over 1 million up to 50 million. There are some key differences, but mostly I would say that if you're going to do a small public offering, the SEC doesn't require their stamp of approval before you launch. They do require you to go through a registered funding portal that's registered with FINRA, like StartEngine. And they do require you to lay out the information in a very specific way, and they have more specific marketing guidelines, or rules, not guidelines, versus a or a large online public offering, which is up to 50 million, where they do have to put their stamp of approval on it. So there's a lot more disclosure. There's a lot of back and forth, so it can take up to 3 months for you to actually get your approval. But once you have that approval, you have a little bit more protection there, and the SEC is more comfortable allowing you to raise more money. And then because they have reviewed everything, you have more freedom with marketing. So our very first raise on our platform was Elio Motors, which raised almost 17 million. It was 16.92 million from around 6,300 investors. The average investment being about $2,600 per investor. They launched their Test the Waters campaign, which is allowable under Reg A+, which is essentially a non-binding campaign where you get indications of interest. It's allowed under Reg A+ because you're not actually going to be able to launch until the SEC gives you their approval. Versus under a small OPO, you can't do any kind of marketing, conditioning the market prior to doing your raise, because they're not going to be able to have the same opportunity to review your materials. So Elio launched the Test the Waters in the summer on June 19th of last year, and then they closed in January. They were the only IPO in January of last year, and they ended up going live on the OTC markets. And actually, what I think is maybe the best thing about that particular campaign, in addition to the fact that it proved that this was possible at such a large scale, is that the shares have been trading up 80% since. So they skyrocketed from their original cost of $12 to $70 at the very beginning, and then they've settled between $20 and $22 since then, which means that the investors in that campaign actually had liquidity and could have a return on their investment in January and even now.
First of all, these are federal, right? It's not by the state. I can sell the name, Guam, whatever. There's no geographic restriction, just U.S. and territories for these offerings.
Where can you sell the securities? Just in the United States? Is that what you're asking?
Yes.
You know, that raises another interesting question. You know, one of the annoying things about all these private placements that I do up in Silicon Valley is I got to go deal with every state where there's an investor. And if you're out here in the West, it's not that big a deal. You know, there might be a notice. If you're on the East Coast, it's kind of expensive. You know, they charge you to file these forms, these notices.
New York charges you $1,500 if you want to sell any stock in that state.
Yeah. What, do I have that problem? I'm sorry, Gene, go ahead.
For example, he's talking about you have to deal with every state, and every state has a fee. Some's free and some $1,500. So that's an issue that you have to deal with, and you have to have an attorney to go to every state and say, we're thinking about selling some stock in your state, and we want to file, and you go through the process. So it's onerous.
It's a hassle.
But with the Reg A, you're exempt from that. Okay. And that's the best thing about Reg A. And the states put up such a hissy fit. They said, you mean we're not going to be able to? No, you're not. We're going to exempt everybody from that merit review, because every state can, if you're not listed on the New York Stock Exchange or the NASDAQ, every state can say, let's see now, you want to sell some stock in our state? Let me see that paperwork. We may not let you sell it here. As a matter of fact, Apple Computer, in their IPO, could not sell any stock in Massachusetts. They didn't think it was going to be good enough deal for the people in their state. So you don't have to deal with that with Reg A. You're exempt from all of that.
And you're also exempt from it for regulating crowdfunding.
Yes, both of them.
Both of them.
And crowdfunding
Yeah.
regulates.
Sorry, I asked about economics on the low end, which sound kind of daunting if you want to do things like really dotting the I's and crossing the T's. How this other offer you talked about, like, I don't know if he actually raised $17 million or that was the capitalization, I'm sorry, the valuation of the company. But to get $17 million, is that possible on your site? And then what do you have to,
They spent over $500,000 on marketing.
They did it on our site, so yes, it's possible. The economic. I mean, the filing. I think in the case of Elio Motors, they got a lot of discounts because they were the first. So there were a lot of services that they got very low because people wanted to get in the game. But now, yeah, you'd be looking at spending about $100,000 on that offering. One thing that we think is a really great pathway at StartEngine is to start with the small OPO and then move into the large OPO once you actually have more capital to do it.
As a marketing matter, I assume.
For both, I mean, you're doing everything at a smaller scale. We found that with Test the Waters, if you decide to do a Test the Waters, you're still spending a lot of money on marketing, and you're not getting anything out of it. Whereas if you are if you're actually selling stock in a small OPO, you're testing the waters in a way, but you're actually getting that return. So while you're figuring out what actually works, you're doing it in a more real way where people aren't just saying how much they're going to invest, but they really are giving you money. And then you get to experiment a little bit more with what works, and then from there you can take that capital and use it.
The marketing firm that did the Elio Motors, the principal there told me that they spent $675,000 to get the 16.9 million, and so and he said, you know, people should figure 10% of your raise, because you're going to give what, 5% to the portal.
Yes.
Approximately, you're going to give 5% to the portal, and then you better figure another 5% for your marketing.
Mm-hmm.
So and you say it sounds onerous and difficult. It is. It is. It's expensive, and you have to be careful, and it's not easy. But you know, you can get money though.
The question over here.
Yeah. You said that they're able to resell their shares once they've invested. Do you guys have an exchange on, or do you just list it on like a profile?
We do not have an exchange at this point on our platform. The Elio went on the OTC, so that's where that's happening. But once there's a 1-year lock in a small OPO, so once you can trade the shares, you can trade them really however you want, because it goes through an online transfer agent. But you could literally put the offer up on Craigslist. I've got this many shares in this company. This is how much I'll sell them for, and you just do the transaction with the transfer agent. Yeah.
Okay.
From one transfer agent to another.
Yeah. Can you lock it off?
As
like, let's say you like the platform says you're not allowed to do that. Like you're not allowed
StartEngine?
Yeah, you say you're not allowed to take this to Craigslist and sell them. You can only sell them on the exchange via like
I don't know actually. Do you know about that? That hasn't come up.
Okay.
We don't have an exchange, so that hasn't come up.
Yeah.
I don't know, but I don't think so.
For regulation crowdfunding,
Mhm.
there is a 1-year holding period once you do purchase the shares, and there's some exceptions, for transfers like back to the company or to family member, or the shares may be registered. And then after that, market can be developed for the company's shares.
Yeah, so I've done 2 reg offerings in the past, so this question is for you two in the middle of the platform. Sorry, attorneys. I want to understand more about how the platform works. So me as the principal, I'm going to start a film fund, and I'm going to do a traditional offering, and then I'm going to take that and so let's go with your company first. So are you licensed? You're already licensed with FINRA/SEC. So am I still going to go and submit my paperwork to the SEC, or am I just submitting it to you? You're vetting through it, and then you're putting it on your platform. Does that make sense?
Either one, actually. As far as your paperwork,
Are you talking about a reg CF?
A CF or an A, I'm not sure
Okay.
how. We
Okay.
might start with a CF.
You're talking about a
and
public
bounce
offering, not a 506.
Right,
Right.
not a 506.
you're just explaining your experience.
Right.
Right. So you in a large OPO, which is Reg A plus, you'd actually be filing that. Your lawyers would be filing it into Edgar with the SEC.
Right.
With a small OPO, you have the choice. Either you can have your attorney do that on the side, and we'll just work together with them, or you can actually submit everything through our platform, and we'll file it for you.
Got it. So we'll do whatever the offering paperwork is, submit it to you, and then you'll.
Yes, we do due diligence on it. We'll get back to you if we have any concerns or if something needs to be altered at all in order to be sufficient for our due diligence. And then, yes, we can submit it for you.
Okay, great. Thanks.
I'd like to tell you the biggest difficulty of Reg CF is before you file your Form C and before you list on the portal, you have to keep your mouth shut.
Right.
You can't tell anybody what you're doing. It's a very serious issue, because if you do, and you go out to a meeting like this, if I was doing an offering and I came out and said, I'm doing this
I
offering,
didn't say anything.
then you can get in
questions.
trouble, see? So you have to be very quiet. And then when you are posted on the portal, everything that you do has to direct people to that portal.
Right.
You say, we're taking investments, go to StartEngine.
What's the time frame on getting something from start to finish?
A focused group can do it within 30 days. And then you can leave your campaign open. 30 to 90 days is a pretty common time frame for keeping it open. We've seen longer than that. When a company is a little bit more distracted, it's probably more like 60 to 90 days. And it also depends on who you're working with in terms of a CPA and a lawyer, and whether or not you're in a rush. But you could do it within 30, for sure.
Thanks.
Okay, we're at 7:30. We'll take one more question, and then I know our panel is going to stick around if people want to talk offline, answer more of your questions.
Well, can you just talk a little bit more about that? You have to be quiet before the offering starts. So if I'm an existing company and I have a network of, customers that I'm hopefully looking to be my future investors.
The question is,
how do you prime?
talk more about. You said a magic word there, prime. You cannot prime. You cannot go out and get everybody excited about your offering prior to the offering. As a matter of fact, most of the offerings you can't do that with. They don't. And here's why. Because you get people all excited. You tell them you're going to make $1 million, and you get them to sign something after they've had a couple of glasses of wine right now, quick, before he changes his mind. No, because people later they realize, well, wait a minute, I didn't see that part in the agreement, and I didn't realize that you guys were this, and I didn't really know about that part. And so they don't want to prime anything. They don't want to condition the market, get everybody excited. As a matter of fact, they have waiting periods, right?
Right.
You can't even,
21-day waiting period.
without any details, just say we're launching an equity round. It goes
You
live.
can
on
with
X
certain
date.
offerings. if you have a 506c, you can go out and tell the world we're going to be selling stock. And any accredited investor that would like to invest, we can take an investment from you. And you have to prove they're accredited, by the way. That's a little hang up on that deal. But if you want to do a Reg CF offering, now you're dealing with non-accredited investors. Now you're dealing with people that may not know exactly what they're getting into, and the risk, all the risk factors. So you have to explain. You have to be careful about it. You have to put it on a portal that's been carefully massaged with attorneys and procedures and SEC rules and everything to protect the accredited, non-accredited investors.
So if all that information is eventually on the portal when the offering launches, even then you can't before then say, our equity round launches on X date, go to this website.
No, you can't do that. But what you can do is you can continue your regular business.
And you know, we're all exercising caution at this stage of the industry. So right now the answer is don't talk about it because you might say the wrong thing, just don't do it. And that's what every lawyer is going to advise you. Just say nothing until it's launched, and then only say these specific things one at a time, right? That's what you would be
erring on the side of
and direct
caution.
everybody to the platform, because that is what the SEC wants you to do. So the general rule of thumb right now is don't talk about it until you launch, and when you do launch, or when you file, there's a little bit of gray area that some companies have seen, that between filing and launching they may be able to tell some people but not make the information totally public in terms of like preparing a PR statement type of thing, because what we've seen, for example, we recently launched a company, an electric car company, and they didn't launch until a week or two after they had filed, but their biggest fans found the filing because it's public as soon as you file it. So there is information that's made available to the public immediately. And so some of those fans took screenshots of all the filing documents and then posted them into a forum. Now this had nothing to do with the people behind the company, and it was public. It's required to have this information be public, but then people started talking about it. So we're learning as an industry exactly what this is going to look like. But right now it's don't say anything. Once you launch and go live, that's when you say carefully, you direct people to the offering.
And it's efficient. So the advantage is it makes your offering a lot more efficient and can help limit your potential liability.
So my question is, with the traditional crowdsource funding, most investors or donation individuals would get a product. With this is essentially we're only giving them.
No, you can still get a product.
You can. It's just a
perk.
perk.
But I mean, at that point, it's a loss for giving them equity and a product.
Depends on what you give them.
That's right. You might give them a piece of software. It doesn't cost you hardly anything, or something, you know.
Yeah, you can give them. You could give them a credit in the end of your movie. We do have companies who are actively structuring. You know, there's a Test the Waters offering that we have right now, which is a ski mountain, and they're offering skis and they're offering all kinds of perks that do have a cost to them. But for the company, it makes sense because what they're also doing is it's not just about getting investment and getting capital. You're also getting an amazing group of brand ambassadors who you want. They do love your company, and that's why they're supporting it now, but you want to really maintain that. You want to build that. You want to give people a reason to be evangelists for what you're doing. So that's one of the biggest strengths of equity crowdfunding, is that not only are you getting capital, but with all this marketing effort, you're doing an amazing job with your sales if you're actively selling something, and also with building up a community that's going to help really put you into action when you get started.
What kind of companies are you seeing listing on your platform? Well, film, for example. Any entertainment industry companies?
We have a company that's in the live entertainment space and like the live music show space. Mm-hmm. We have not yet been able to make any other media projects public. Mm-hmm. But we are really excited about the potential there. Personally, I think it's going to be an amazing opportunity because one of the most frustrating things to me about the last 80 years between the SEC being formed in 1933 and the Jobs Act being passed in 2012 is that during that time, the people who could make decisions about which movies got made or which companies got funded and how our culture like which areas of our culture flourished because they got financed, those people were only 4% of the nation. And now we're finally opening it up where there's a democratic process to this. And yes, there are some onerous aspects of it, and it's not fully streamlined and easy and normal yet, but it's such a great opportunity for us to create something and allow the crowd and the people to make decisions about what we're doing.
Wisdom of the crowd.
It'll be even more interesting when they declare the accredited investor rule unconstitutional.
I'm looking forward to seeing that.
But why don't we conclude the formal program here? Like I said, I see a few of you still have questions, but I know our panel is going to stick around. So thank you, Samico, for the space. Thank you, and whoever. Who bought the wine, by the way?
MediaShares was all the goodies back there.
Thank you, MediaShares, for the wine. Thank you, panel.